Okay. Yeah, so we'll just finish off these readings, all this properly theory. 62.
So I also had a few doubts in the portal questions, but are we going to do it later on?
We have to do all the questions, right?
Okay.
Just that I don't want this to be like left like in a very haphazard way. I don't want to finish so properly theory, but certainly we will be doing questions for all the subjects. Okay. So what is your doubt here? But what happens, see, once this fixed income, if you are strong in fixed income, it is connected to many other subjects, the calculations and all those. So theory subjects will go faster. So this is economics, corporate issuers. Corporate issuers are all self-reading only. So economic, these all will not take much time. Quickly, I will be finishing it up. Okay, but the tougher one will go, I am taking it slowly because I know this will help me in other subjects because your foundation will become stronger. Okay. But we'll be solving questions for all the subjects. Okay.
Okay.
Okay, here what is the doubt you said? 62.
Structural subordination. It's lower.
Yeah. A subsidiary's debt covenant may restrict the transfer of cash or assets upstream to the parent company before the subsidiary's debt is serviced. So that means uh, now imagine Bajaj Holding is there. You can see the screen, right? Bajaj Holding.
Yes.
Now it might be having shares of Bajaj Auto, Bajaj Electricals, Bajaj, um, maybe Finserv. Then, okay, let's say all these. So now, uh, even though this is the parent company, so normally what we will think is this company's value should be added completely to this company. I mean, whatever shares, let's say 30% they are holding. So this 30% of Bajaj Auto forms the value of Bajaj Holdings, correct? But practically, will they get that 30%? The answer is no. Why? Because now Bajaj Auto might have issued some, some bond debts, all those. So what will be the first priority of Bajaj Auto? To pay to these bondholders before Bajaj Holdings can take anything from Bajaj Auto. So that's why this is called structural subordination. So by structure, Bajaj Holdings number will come after this bondholder. No? The first priority, if at all tomorrow Bajaj Auto goes bankrupt, whom will they pay first? To these bondholders or to the Bajaj Holdings?
Bondholders.
To the bondholders. So that's why by structure, Bajaj Holdings will get lower, importance here, even though it is holding all different companies. Now you see this. In a holding company structure, both the parent and company and the subsidiaries may have outstanding debt. A subsidiaries debt. Acha. Okay, so now imagine even Bajaj has given debt. Even here bondholders are there. Now they are not able to pay Bajaj Holdings. Now what should they do? They should get money from Bajaj Auto and then they pay. But the problem is they cannot get money from Bajaj Auto. Why? Because Bajaj Auto is a separate company. They are first answerable to these bondholders. So Bajaj Holdings is stuck up now. It is not getting the priority, even though this is the parent company. Are you getting the idea here?
Yes, sir.
Okay, now keeping this in mind, you read upstream means to the parent company upstream, and this Bajaj Auto is the downstream.
So it is like in case of bankruptcy, like the bondholders of the subsidiary companies should be paid first, and then the equity holders of Bajaj Holding. Is
See,
it?
if Bajaj is in trouble, Bajaj Holdings is in trouble, they
Yeah.
cannot take money from Bajaj Auto immediately. Why? Because
Okay.
Bajaj Auto has to first pay to this bondholder, Bajaj Auto
Bondholders.
bondholders.
Right.
So that's why Bajaj Holding is not getting the priority. So because of which their ratings can come down. A subsidiary's debt covenants may restrict the transfer of cash or assets upstream to the parent company. So it is restricting before the subsidiary's debt is serviced. Okay, so even though the parent company's bonds are not junior to the subsidiaries' bonds, the subsidiaries' bonds have a priority claim to the subsidiaries' cash flows. So effectively, parent company's bonds are subordinated. Is it okay?
Yes, sir.
What is the next doubt? A module quiz, you got any doubt? Have you tried module quiz?
So here the fourth one.
Higher credit risk is indicated by a higher. See, now you see, numerator is EBIT. EBIT is what? Earnings. So higher it is good only. Higher it is not a higher. So higher EBIT will have lower credit risk, right?
Right.
So this will not be the answer. Is it okay?
Okay.
Now, what is RCF here? RCF means residual cash flow. What is RCF here? Free cash flow. No, FCF, RCF, retained cash flow. Retained cash flow is operating cash flow minus dividends. Okay, retained cash flow. That means this is also positive number, right? Cash. So if you have higher cash flow, then the credit risk will be lower, na? So even this is not the right answer. When you have higher debt, then only the credit risk will be higher, right?
Okay.
Is it making sense or not?
Yes, sir. Got it.
Okay. 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 Next doubt.
In theory, that's all I had. I had more questions in portal.
Okay, fine. So 63 you have read, you don't have any doubt, right?
No.
No. Okay, fine. Then 64 you read, you don't have any doubt, right? This is also fine, na? And 65 you have not read only, correct?
No, sir.
Okay. But 64 you read, right? No doubt, correct?
Yes, no doubt.
Okay, 65. Okay, yeah. So this is also something you can read, understand on your own. It's not a problem. Recourse. Did I explain this? Recourse, I explained, right? I have marked it here. Here, this one you should give importance, okay? This one, agency means this government sponsored. This one you should give importance. Non-agency is this one. Then, VAM. This I think I did not explain last time. So let me finish this one. Weighted average maturity. This is a very easy one only. Pass-through rates. Pass-through rate means that mortgage-backed security is only called as pass-through rates because we are passing on the interest rates from one end to another end, right? See, this is the bank. These are the borrowers. This is government-sponsored entities, and these are the mortgage-backed securities. So they were paying 4%. Then they will pay 1%. Bank will take 1% as their commission. Then Government sponsored entities will take 1% and then they will pay 2% to mortgage backed securities. Okay. Okay, we'll do this sum now. A mortgage backed security contains 3 mortgages, A, B, C, with details displayed in the following table. Interest rates, okay. Calculate weighted average maturity and weighted average coupon. So all you have to do is see interest is there, beginning balance is there, current balance is there. So when beginning balance and current balance is given, beginning balance does not matter to us. Current balance is what matters. Original term to maturity and months to maturity. So again, original term does not matter now. Months to maturity, how many months are left out, that is what matters to us. Now weighted average maturity. So this is the maturity, and we have to put weight to it. Weight means based on the amount C. So it will be 210 is the maturity, and we have to put weight to it, weighted average, right? So 90 is the amount. 90 out of, just take the total of this. This is the value of the entire portfolio, right? Just take the total of this 90, 72, 247.
409.
Mm-hmm.
409.
409. So for 90 out of 409. Okay, just calculate this, keep it in store 1.
Into 210, right?
210 into 90 by 409.
Yeah, that is 46.21.
This is the weighted average maturity, okay, months. Keep it in store 1, okay.
Yeah.
Then similarly, 100.
72 by 409, right?
100 into 72 by 409.
Okay. So why like what is this 102 210?
This is the maturity, and I am giving weight to it. Weight means based on the amount
Okay,
that
the
I am.
maturity column.
Yeah. Weighted average maturity, that is the topic.
So this is 17.60. And the third one is 169.09.
Hmm.
Yeah. 169.09.
Add up all this.
That is 232.9095. 9095.
232. Okay, that is 233. Okay. Similarly, we have to calculate weighted average coupon. So this is the coupon, you have to give weight to it. So coupon is 2.6.
And
Weight is this weight only, 90 by 409.
that is 0.0057. Yeah.
So you keep storing, okay. One percentage. This one is 7.2, 72. No, this is 72. What is this? 790. 72.
72. Yeah, so this one is 0.0017. 0.0017. And this one is 0.0326. 0326. 0.0326.
Add up all this.
Yes. So that is 0.04009.
4.0. Okay, this is it. Very simple one. Fine.
Yeah.
Then collateralized mortgage obligations. It is collateralized by mortgages. Okay. Each collateralized mortgage obligation has multiple bond classes tranche that have different exposure to prepayment risk. Okay. Z tranche. So there are various tranches. Okay. So because there are various tranches, remember I said in CDO, senior secured, and this is unsecured. Yeah, unsecured. So all these are there. Okay. Similarly, now there are many varieties. Z tranche, other CMO, collateralized mortgage obligations. So collateralized mortgage obligation, these are some, terminologies. Some will be overlapping terminologies also, okay, possible. So based on the sequential of payment, various types are there. Z tranche means no interest payment during a specified accrual period. So Z tranche is typically the lowest ranking tranche in CMO structure. Okay, so you remember this line. Z tranche is the lowest. Lowest means what? Why? Because it receives. You think like this is zero coupon bond kind of thing. No coupon, no interest. They will be paid. Okay. Instead, during the accrual period, the tranche accrues interest as extra principal. For example, if your Z tranche with a coupon rate of 5% has $100 of principal outstanding at the start of the accrual period, then at the end of the first period, the principal of the Z tranche will be increased to 105. Okay, rather than Z tranche holders receiving 5 cash. So that means here every year you are supposed to pay, let's say 555 and 100. Instead, you will get how much? 115 here. At the end only you will get. So that means that money they will utilize, and at the end you will get it. Z tranche. Principal only securities means these securities pay only principal from the collateral pool. Hence, they are effectively zero coupon securities. Decreasing interest rates and increasing prepayment speed benefit. So that means here decreasing interest payment and increasing prepayment speed benefit. That means they will be paid sooner here. Okay, because their returns comes purely from the difference between the price paid and the repayment of principal. So that means if they get, imagine if they are paying 100 rupees, if repayment is happening for 110, so they will get 110 rupees. That way. So they are betting that I am giving you 100. Once they repay, you give those back to me. Okay. So it is comes purely from this one. Interest only, the securities pay only interest. The name itself says. So decreasing interest and increasing prepayment harm. IO means interest only tranche. Okay. Floating rate tranches. These tranches pay a coupon that is linked to a variable. So this name itself says residual rank junior to all other tranche, similar to equity tranche. Okay. This is an important one. Planned amortization class tranche and support. Important means you might get one questions. In the website and all I have seen here. Just go through this for a minute. First, then I'll explain. Read? So PAC tranche, planned amortization tranche and support tranche. So planned amortization tranche means is structured to make predictable payments to investors as long as prepayment speeds remain within a certain range. Okay, as long as prepayment speed remains within a certain range. So this is okay. So that means here, this for this tranche they will pay as long as if the speed is so and so range. If the prepayment speed increases, the support tranche receives the principal. That means first priority is PAC. After PAC gets the payment, support tranche. So who is taking more risk over here? Support. Support tranche is taking more risk over here. So first priority is PAC. PAC is what? As per the plan, it will be paid. Second is support tranche. Okay. If prepayment speed increase, the support tranche receives the principal repayment in excess of those specifically allocated to PAC tranche. Conversely, prepayment speed decreases, principal payment to the support tranche are curtailed. So the scheduled PAC payments can be made. That means if it goes slow, then this support tranche will suffer if the prepayment happens slow. Okay, in this way, both contraction and extension risk are reduced for PAC tranche investors. However, this protection is limited by the range of prepayment speeds under which the support tranche can operate. Should speed move outside this range, PAC tranche will not receive payments in line with its planned. So if it goes outside, they will not get the payment. So like this, many varieties of tranches are done. So this is only generally done like this, but there is no limit. All these are different varieties. Okay. Commercial mortgage-backed securities means mortgage-backed
So can you
securities.
explain PAC again? Like I didn't get it.
So PAC means if the payment, they say till the payment is within a certain range. Okay, within this range they will be paid. First they will be paid. So it will be see, as long it is structured to make predictable payments to investors as long as the prepayment speed remains within the range. That means as long as they are, so let's say um, between this time to this time period, whatever prepayment happens, so all that, if within this time period whatever prepayment is made, that will be paid to these people, and if anything extra if they get, that will be given to the support tranche. Between this time period, okay, between, see, as long as the prepayment speed remain within a certain range, so that means as per the predictable, like between this time period, if prepayment is happening, within this time period, they are going to get the payment.
PAC ones.
Yeah, so they will be paid first. Beyond that, if they get anything more also, then that will be paid to the support tranche. Okay, now suppose if they are not able to make the payment as per the PAC agreement, planned amortization. Okay, planned amortization means what? As per the planning, this much payment will be made to you, but the prepayment is not happening only, or if they are not able to make the payment, then in that case support will suffer first. So that means during good
People
time
who have
support will get late, and during bad time support will suffer first.
So like people who have gone for PAC things, so they'll receive less interest, right, compared to support. Like,
No.
Can we say that?
Support will compared to support, they will get less. Support will get
PAC,
more
right?
because support is taking more risk. Correct.
Yeah.
Okay. So all you have to know is planned amortization. Okay. Yeah. So all you have to know is planned amortization. Okay. So planned amortization. Okay. So all you have to know is planned amortization. Amortization class means they are, certain in a planned way, they will be paid. So they are taking less risk than the support tranche. Fine, okay.
Yes, sir.
Is it okay now?
Yes, sir.
Commercial mortgage-backed securities means mortgage-backed securities backed by commercials. Commercial means what? Malls, example mall, okay, or this warehouses, all this. RMBS means mortgage-backed securities backed by residential homes. CMBS, RMBS, okay. This you can ignore. This part, if you ignore, it's fine, because it is, um, you know, basically what it means is it is there in FSA as a bit interest coverage ratio. Yeah, it is there as interest or a bit to, yeah, interest coverage ratio. Yeah, it is interest coverage ratio. Okay, this one is also not required. Basically, how much loan they are giving for the value of the collateral. That's what it means. Right. Okay. Then current mortgage bank. Okay, so this is also, if you ignore also, it's fine, but it's very easy only. Loan to value means how much loan given for the value of the collateral. Debt service means it is interest coverage ratio. That means how much income you are generating to service your debt. Okay. Then balloon payment is all okay. Balloon payment means in one shot they are getting at the end payment. Okay, like in zero coupon bond, it is balloon payment. If the borrower is unable to arrange refinancing to make his payment, the borrower is in default. This is called balloon risk. Okay. Okay, that's it, right? That's it. Okay, fine. Now we will take your questions, fixed income questions. Curriculum, should I open? I have to open curriculum. Curriculum fixed income. Which question now?
Yeah, sir. Just a minute. So page number 2020. Page 20.
Hmm.
Page 20. Third one.
It's a case study.
Yeah, so
Okay. Case study is there.
So for every module, they've given a case study only.
yeah, like it's the same.
Oh, but in website there was no case study, no?
No, there are case studies in the website as well.
Website as well.
So like,
Okay.
are we going to have such kind of questions? Like, have
No,
they
you
like
will not get
created?
questions. Yeah, no, you will get only standalone multiple choice questions only.
Okay.
Uh, this seems to be derivative questions.
Yeah, they are all mixed.
Yeah, yeah. Okay, Antelas, because it says Euro 250. Anyways, it's not a worry. Third question, you have problem.
That's
Okay.
third and fourth one in this
Okay,
module.
so what is the third question? Let's see. Third question is Antelas AG's issuer specific credit spread rises by 25 basis points per annum. Okay. 1 year after the FRN issuance, which are the following best describes how Antelas AG FRN's coupon would change as a result? Okay. Antelas AG's issuer specific credit spread rises. Issuer specific credit spread rises by 25 basis points per annum 1 year after the FRN issuance. Okay, spread rises by 25. Which of the following best describes how Antelas AG's FRN coupon would change? Antelas AG's FRN coupon payment to investors will immediately increase. Okay. German emerging technology company focused on manufacturing process design. The firm has developed several valuable patents related to micro machining and metal 3D printing technology and derives its revenue through licensing royalties and consultation services. Intel has recently issued the following debt instruments: 4-year floating notes. Okay. MRR plus, so 4 year. So 4 years and MRR plus refer respectively to which bond features? Which are the following best describe source of payment? Okay. Issuer credit spread rises. Fine. So initially it is MRR plus 25 basis 4 years. So here you will pay MRR plus, based on this MRR, initial MRR, you will pay plus 25 basis points. 25 basis points. Um, 25 basis points. Okay.
That is 250, na MRR plus 250.
Acha, 250 basis points, not 25.
2.5%, right?
2.5 percentage. Okay. Now here it says until ages issuer specific credit spread rises by 25 basis points 1 year after the issuance. Which of the following describes would change as a result? Intel's coupon payment to investors, it will not immediately change. It will change by 25, will not become effective until the next full debt coupon period begins. That means when next full immediately increase means what? Immediately it will remain unchanged? No, that will not come. It is between A and B. It will increase, but it is again, see, actually what happens when is this increasing? It is increasing 1 year after. That means here it is increasing. So if here it is increasing to 275 basis points instead of 250, now that payment will happen here. Can you understand this one?
Yeah,
This
like after,
MRR will be paid at the end only. So this MRR and credit spread will be paid at the end. Now that language only we have to understand. So that language is coupon payments to investors will increase by 25 per annum, but will not become effective until the next full debt coupon period begins. Okay, so this it will be paid here only. But what is that English language mean? That's what we need to understand. See, do they mean that investors will immediately increase? See, they are so immediately means what? It is immediately increasing, but it is being paid here only at the end of the second year. Is this what they mean, or they mean that it will increase by 25 basis points per annum, but will not become effective until the next full debt coupon period begins? Next full debt coupon period is it will be paid here, but which language or which English says that it will be paid here? That's what we have to find out. So it is more to do with English problem. What do you think? What do you people think? You understood? The answer is that it will be paid here only. Okay, for sure. It will be paid. Have you understood, Shravani? You have understood?
Yes, sir.
Yeah. So now, which English is telling that it will be paid in the second year? That's what I need to find out. Okay. So any idea here? I think it is B, because immediately increase by 25 basis
is
points
it
means
B?
B. Yeah, check.
Is it B, sir?
Yeah, it's B.
Answer key, they've given C.
The coupon will remain unchanged. Which are the following best describes how a coupon afferents coupon will remain unchanged? Coupon will remain unchanged. Rises by 21 year after the issuance. Which are the following best describes how until us? Okay, let me see the answer only then. It should not be C. Wait, I'll open another copy. For the spread is 20 the coupon. Okay. So here again, there is no technical. This is more testing all English only. It's very irritating. Now they are saying coupon will remain unchanged. Uh, uh, coupon will remain unchanged. The spread is fixed at 250 and the coupon will only change when changes in the MRR take place. The spread is fixed at 250 basis points and the coupon will only change when changes in the MRR. Oh, yes. Ah, yes, it's my mistake. Yeah, correct. Okay, it's correct. See, Yeah, they are correct. See, okay, coupon is equal to MRR plus 250 basis points. This is what they have agreed. Yeah, it is my mistake now. It's very silly mistake also. See, coupon is equal to MRR plus 250 basis points. This is what the company has agreed. So, what will be changing every year?
MRR, right?
MRR. So, if the credit risk of the company, you leave this sum for a minute. Let's say there is one company, company A. Company A, it's a 4-year bond issuing. Coupon is equal to 10 percentage. IOI is 8 percentage. Okay. And future value is 100. Present value is whatever amount. Okay. Now, if the IOI changes to 9 percentage, what will be the coupon?
It will remain the same, right?
Exactly. Correct. So only here also doesn't matter whatever be the IY in the market. So this is indicating all additional risk. Here they have already fixed that I am going to pay you 250 only. Only when MRR changes, accordingly my coupon will change. Is it okay? Because this amount 250 is fixed, no? This amount is called quoted margin. This quoted margin is not going to change. It is already fixed 250. Only MRR will keep changing. So if this is changing in the market, it doesn't matter only. Just like here, 8% change to 9%. It doesn't matter to the company. Okay, 8% change to 9%. It doesn't matter to the company. So what matters to the company is what? Only MRR. If MRR is changing, then only they have to pay accordingly. Is this clear or not?
Yes.
Yes, sir.
Yeah, it's very easy one, but unfortunately the language is so pathetic that then even easy question becomes difficult then. Okay. If so, whatever I was thinking that MRR is changing and so it will affect in the next year. Even though I was writing here all 250, 275. So in my mind all MRR, and they know the psychology. They know that we are going to think like this only. And that's how exactly they thought, and then they have framed question that we will think like this only. It has been already studied by them. Okay. Then fourth one, calculate the value. This one you asked, right? This one only, no? Fourth one.
Yes, sir.
Hello.
Yes, sir. Fourth one. The fourth one.
Yeah, calculate the value of interest payment to bondholders on the maturity date if the MRR is 0.5 percentage per annum for the final interest payment period. If the MRR is for the final, okay. So that means last time period 0.5 percentage, 0.25, 0.25 percentage plus 250 basis points. So that comes to what? 5%. That comes to what?
2.5%, right?
Yeah, 2.5. So 2.5 plus 0.25, correct? To 100 basis point is 1 percentage. So 250 basis points is 2.5 percentage. Just add these two. 2.75 percentage.
2.75%.
So 2.75 percentage. What is the principal amount?
Coupon is
2.7.
2.75, right?
Yeah. Principal amount is
250 million.
so 2.75 percentage into 250 million, or you can just simply, they have asked the entire amount now, so you can simply do 2.250 million plus 2.7 percentage. Let's do plus 2.75%. You will get the final figure.
It's 256,875,00.
Check.
No, sir, it's B.
This is again wrong. Wrong. Is this annual or semi-annual like that? Anything? Quarterly. That's why.
So we divide by
Quarter.
4.
Yes, this is quarterly.
The PV
Divide by 4 means
200
only interest you have to divide by 4. So you do one thing. 250 million into 2.75% divided by 4. Calculate this amount.
$1,718,000, $18,750.
Okay. Plus 250 million principal
Plus
amount.
250. So that is 251,718,750.
Yeah. Now let's check.
So here that is B.
Check.
So here the PV is $250 million. Like
This is the par value.
par. So that
Par
is
value.
FP.
Future value.
So future value, and we are getting the P. Okay.
Yeah.
And what is the interest rate? IY we took 2.5.
What is the
IYY.
I by Y? For this bond, it will be 2.75 only IY because it is trading at par. If it is trading,
Okay.
assuming it is trading at par, because there is no other info
So
given
both
here.
coupon and IYY will be
Same.
2.75.
Yeah.
Okay.
Fine. Okay. This is okay. Okay. What is the
Yes.
next doubt? Next doubt. Hello.
So I'm going to the next model. I just page 52. The fourth one.
Page 52.
The fourth one.
Okay, conversion value will be rise to 75. So multiplied by 75. So how many bonds? One bond can be converted into how many shares? One bond can be converted into how many shares? Conversion value 75. Okay, conversion price is 75. Current conversion is 60. Conversion price is 75. If Dillo's share price on the Frankfurt Stock Exchange were to rise to 75, the bond's conversion value. Okay, I'll just read properly. 7 years from settlement. Okay. Okay, so this is 1 unit is 1000. So with 1000 per bond, so 1000 per bond, so 75 75 is for one share. So for 10,000, just divide this 1000 divided by 75.
That is 13.33. It's recurring.
Into 75, not 75, 13.33. I will get this many shares. At the rate of 75, I will get this many shares. So multiply by 75, I will get 1000. Then 1000. Yeah. The bond's conversion value were to rise to 75. No, current share price is 60. At the rate of 75, it will be converted. Okay. Current share price per dollar conversion price 75. Current share price 1000. Okay. Just check if it is 1000, or I'll see here only.
It's 1,000.
1000, no?
Yeah.
Okay. So yeah. See, what it means is when they convert, for every 75 they will give one equity. So for 1,000 rupees bond, you have invested 1,000 rupees, so you will get 13.33 bond. So when equities, you will get 13.33 equities. When you get 13.33 equities into 75, because its price in the market is 75, so total value will be 1,000. Is it okay? For conversion, so how you should think is, they said you have the right to convert. When you convert it into equity, it will be converted at the rate of 75. So at the rate of 75 means, in other words, you will get 13.33 equities. Okay, and in the market, if equities value is actually 75, then you will get 1,000 rupees. If the in the market, if it is 80, then accordingly you would have got more money. Is it okay now? Have you understood or not? Hello?
Yes, sir, understood.
Okay.
So
Okay, what is the next one?
the next model.
So I'm sending more questions from the portal from this module. I had one more doubt.
Yeah. You're sending in the WhatsApp group, is it?
Yes, sir, sent.
Okay. Just 1 minute.
This will be interest income, right? Like what the gains from a zero coupon bond is considered as interest income, right?
1 second, wait, hold on, wait, okay, 1 minute, just 1 minute. What did you say? You sent, is it?
Yes, sir.
Okay, this is the question. Okay, you both can see, right? She sent in the group only. Okay, so this is the question. So it says, investor domiciled in a country with an original issue tax provision, tax discount provision. He purchases a zero coupon bond at a deep discount to par value with the intention of holding the bond until maturity. At maturity, he will most likely face neither capital nor capital gain nor capital loss.
I didn't understand the
Intention is-
explanation they've given.
It's
The
in
Okay. So, okay, then let me read the explanation. Correct, because for bonds such as zero coupon bonds issued at discount, the tax status of the original issue discount is an additional tax consideration that varies by country. The original issue discount is the difference between the par value and the original. For example, United States includes a prorated portion of the discount in interest income every tax year, while Japan does not. Prorated portion of the discount. Under the OID tax provision, the investors will recognize a prorated portion of the OID as taxable income each year and pay no capital gains tax upon prorated portion of the original. Under the OID tax provision, the investor will recognize a prorated portion of the as taxable income each year and pay no capital gains tax. See, what it means is, say for example, imagine you are buying one bond for, let's say you are buying a 30-year bond or 50-year bond. Okay. And so many bonds you might have bought, and 50-year bond means what? You might have bought it for maybe like 100 rupees. So it is discount is 900 rupees. So that means every year you are earning something. No? Just calculate how much is it coming to. N is 50 years. Present value is 100. Payment is 0. Future value is 1000. How much is it coming to?
IYY is 4.7.
4.7. So every year,
0.71.
4171. So every year you are earning 4.71. 4.71 percentage means what? 104.71. Like this only, it is growing every year, and it is reaching to 1000. Correct? So, but practically you are not going to get any cash. So if you are not going to get any cash, so you should not pay so you should not pay tax. Okay, that's what Japan says. But US says no. If I do like that, then everybody will buy this kind of bonds, and then nobody will pay tax. So US says that you are not getting this cash in your hand, but you have earned, right, 4.71. Pay me tax on this amount. Okay, so pro rata, you have to pay tax on this amount. You understood this one? Meaning, on this
Yes,
amount,
sir.
you are supposed to pay tax in US. Okay. You will not get this kind of question because these are country specific one. But here to understand, you can get this point that even though you are not practically earning any cash, you are supposed to pay tax. Now here I told you 50. Everybody, if you think that 50 who will buy, then there are many 10-year, 20-year bonds available in the market. Then everybody will say like, I will pay tax after 10 years. Correct? Everybody will postpone tax payment. They will say like, when I will grow old, that time I will pay tax on 1000. And many parents will, transfer this to their kid's name, and then they will die also in between, right? All those things are possible. So that means you can evade tax using this method. So US says whatever you are earning, you have to pay tax. Is it okay?
Yes, sir.
Yes.
Okay. So this is what it means. And yeah, coming to the question, like neither capital gain nor capital loss. Now, what do you mean by capital gain or loss? Capital gain or loss means, now you see after 1 year, this bond's price will be 104.71. But suppose if you sell it for 105.71, then that means there is a gain of how much? Not 5.17. It's not 5.17, it is 1 rupee. You have gained 1 rupee is your capital gain, because bonds price automatically it is coming to 104.71. Na? So this difference is called capital gain. Capital gain. Is it okay? But when it comes to maturity, it will reach to 1,000 only. So thousands product, you are getting 1,000. Its value is 1,000, you are getting 1,000. So there is no capital gain or loss here. Only here, if it is available, here if you are selling at 104.71, then what is the capital gain or loss here? Instead of 105.71, if you are selling it for 104.71, how much is the capital gain or loss here?
No capital gain or loss, sir.
Zero, right? Zero. Okay. So it is
Okay.
not 4.71, it is zero. If it is 105.71, one capital gain or loss. If you are selling it for 103.71, your capital loss is 1. Understood this, no?
Yes.
Okay, this is the
Let's
only
say like
question
if
we
we
have, right?
hold it till maturity, like in a zero coupon bond, it is termed as interest income, right, and not capital gain or loss, no?
Yeah, yeah. Is it okay? This is the only
So
question,
that's
right?
why
We'll
it is
come back
not
to
neither a capital or a nor gain, like nor
yeah,
loss or gain.
yeah, yeah,
Just because of that, the interest thing.
yeah.
Okay.
Okay, we'll come back to that. These questions now. This is the
Yeah.
next one. Okay, what is the
Yes.
next one?
So page number 75, third and fourth one.
Third one.
So
An
is it
index.
like the C is the answer? Like, is it because like compared to equities, like fixed income has much more securities. Like the market is much
An
bigger.
index tracking Bloomberg Barclays Global Aggregate Index would most likely have limited security selections, modest turnover due to changes in market value, modest turnover due to changes, comprehensive exposure to fixed. And this is straightforward, no? It is C. Yeah,
See, yeah. So it is because of that, right? There are many more like
yeah, because these are all global one. It's a global one. So why will it have limited security selection? Why will it have less turnover? It will be more comprehensive exposure. It's a straightforward one.
okay, and the fourth one.
The firm that increases the size of an existing bond issue with a price significantly different from par is conducting uh,
This is reopening.
uh, a firm that increases the size of an existing bond issue okay, with that means earlier uh, it was 1,000, now it is 10,000 with a price significantly different from par. is conducting a reopening private placement. This I have not understood. So I have to see this one. Increases the size of an existing bond issue. Hmm. 75 you said, right? Page.
Yes, sir.
Is it here? No. Is this the one? Ah. Increasing the size of an existing bond. Size of an existing bond means now they are initially they wanted to raise 1000 crore. Now they are raising 2000 crore. So if I think like this, with a price significantly different from par value, is conducting. Yeah, okay, because I cannot call that as private placement, because private placement means raising capital privately from the institutional investors. That indication is not there.
Yeah.
Distressed debt issue is not there because they are raising more capital now. So that means it has to be reopening. Reopening
So
word
it
I
is
have never heard.
reopening. So it is
Okay, that
reopening
word I
because
have
they
not
are
heard before.
making a new issue. Is it because of
Yeah,
that?
yeah. Increasing the size of an existing bond with a price significantly different from par is referred to as the reopening of an existing. Okay, that is the term, reopening of an existing. Private will not come sold to selected investors or institutional investors. Very close to bankruptcy. Okay. Okay, what is the next question? Understood this one? Private
Yes.
placement is
Yeah.
raising capital privately. That indication is not given anywhere. Distressed is not given because they are increasing the existing bond, right? Hmm. What is the next one?
Next module, sir. Page 102.
Okay. Tomorrow, are you people busy? Shravan, you have work tomorrow? Any other evening we will do training? Any other time you have to do all this doubt solving and all?
I'm free
Afternoon
tomorrow, so
also.
I don't have work tomorrow.
Tomorrow afternoon, if I get time, I will ping, okay? In
Okay.
case if you both are free, then we can do at that time also doubt solving. Okay.
So it won't be possible for me. Like,
Tomorrow you are busy?
yeah, tomorrow and Saturday also I'll be traveling on Saturday. So that day I won't be able to attend.
Okay, fine. Okay, leave it then. Acha, tomorrow evening also you are not, you will
No,
not be able
tomorrow
to
I'll
do.
be there on Saturday. On Saturday I'll be traveling. So on that day.
So tomorrow you are there, right?
Yeah,
Afternoon
tomorrow.
also.
No, not afternoon won't be possible. Like in the night I can. At night.
Night you are going to travel.
No, like on tomorrow also, like afternoon is not possible for me. Like regular what we are doing, like in the evening time
Only
is
you are
possible.
available. Okay then. Okay.
Yeah,
Okay, what is the next doubt here? Which page you said?
page 75. Sorry,
70?
102. Oh, 102. Sorry.
Hmm. What is the question here? 100.
The first one. 102, sir. The
Hmm.
first one.
Which of the following is a benefit to your bank that makes short-term loans? Which of the following is a benefit to your bank? that makes short-term loans and issues asset-backed commercial paper. That means it's playing very safe, asset-backed only, and also short-term. The bank receives commercial paper when the bank receives commercial paper when the ABCP is issued. Company is issuing commercial paper and issues bank that makes and issues asset-backed commercial paper. Why will a bank issue asset-backed commercial paper? Okay, we'll see other points. Capital costs are reduced by providing undrawn backup liquidity instead of holding the short-term loans to maturity. The bank purchases a liquid short-term note with interest and principal payment from a short-term loan portfolio to which it would otherwise not have direct access. The bank purchases a liquid. Which of the following is a benefit to a bank that makes short-term loans and issues asset-backed commercial paper? The bank receives commercial paper when the ABCP is issued. This will not come because bank will not, when they are issuing, they will give commercial paper. Okay. Capital costs are reduced by providing undrawn backup liquidity instead of holding the short-term loans to maturity. The bank purchases a liquid short-term note with interest and principal payment from a short-term loan portfolio to which it would otherwise not have direct access. Okay. The bank purchases a liquid short-term note The bank purchases a liquid short-term note with interest and principal payments from a short-term loan portfolio to which it would otherwise not have direct access. Which of the following is a benefit to a bank that makes short-term loans and issues asset-backed securities? Capital costs are reduced by providing undrawn backup liquidity instead of holding the short-term loans to maturity. The bank purchases a liquid short-term note. Bank purchases a liquid short-term note with interest and principal payments from a short-term loan portfolio to which it would otherwise not have direct access. The bank purchases a liquid short-term note with interest and principal payment. So the question itself so difficult to understand only, then how can we predict the answer? See, which of the following is question is okay, understood. This will not come bank because they are only issuing. When they are issuing, they will not receive commercial paper. So capital costs are reduced by providing undrawn backup liquidity instead of holding the short-term loans to maturity. Capital costs are reduced by providing undrawn backup liquidity. The bank purchases a liquid short-term note with interest and principal payment from a short-term loan, but here it says they are making loan. Provide purchases a short-term with interest and principal payment from a short-term loan portfolio to which it would otherwise not have direct access. Why will it not have direct access then? Is not understand question. It should not be A. Then, but B and C I am not able to understand only. This is what is this page number? 100. Let's see here.
102, the question.
Is this the one? I think this is the one, right?
Yeah, the first. Yeah,
Yeah,
it's
it's
B.
B. The bank. Now, what does that mean? Undrawn backup liquidity. It's undrawn by providing undrawn backup liquidity instead of holding the loans. Reduced by providing undrawn backup liquidity. The bank will reduce capital cost. Okay, by providing undrawn backup liquidity instead of holding the short-term loans to maturity. A is incorrect. That known. C is incorrect. Uh, C is incorrect because investors purchase a liquid short-term note with interest and principal payment from a short-term loan portfolio to which it would otherwise not have direct access. That language itself is so tough to understand. Capital costs are reduced. The bank will reduce capital costs by providing undrawn backup liquidity instead of holding the short-term loans to maturity. Undrawn backup liquidity means what? This language I am not able to understand. Let me just read more on this one. I have to go to the curriculum and then read. I'll just mark this question then. I'll just read and tell you next time, okay? Right now I'm this language I'm myself not able to understand the language. Okay, what is the next one?
So I have doubt in the sixth one.
Sixth one. Which of the following statement about high yield is correct? High yield investors benefit from higher bond prices. No, the price will be lower. Okay, reason being, then only the yield will be higher, no? As issuer specific credit falls. Acha, as issuer credit spread falls. Okay, then okay. If credit spread is falling, the price will go up. But in the case of callable debt, these gains are capped at the original purchase price. No, not necessary that it has to be capped at the original purchase price. Okay, so this is not the one. Issuers in the high yield market seek to retain financial flexibility by borrowing under leveraged loans with prepayment features or issuing on contingent. Yeah, this is possible. Issuers who believe that their creditworthiness will decline frequently choose to issue callable bonds because the value of this contingency feature rises as a firm's borrowing cost rise. The value of this contingency feature rises. No, it should be B. It's B. Sixth one. It's B.
Yes, it's B.
Yeah, so this is okay. This language is fine. That one was very non-understandable. This is okay. See, high yield, first of all, why B? Because first of all, see, gains are capped at the original purchase price. There is no such rule that it will be called at the original purchase price. That company will decide, and it will be mentioned in the indenture, like at what price they will call. It they may call at normally they may call premium or they may call it par, but that will be mentioned. So not necessary that it will be purchased only at the purchase price. So that's why it is not the answer. And then here, issuers in the high yield market seek to retain financial flexibility by borrowing under leverage loan. That means because they know that they are not good companies, their ratings are poor, so they tend to borrow under leverage loans. That means less loans in limited way they are borrowing with prepayment features or issuing bonds with contingency features so that they are able to repay also quickly whenever they get money. Okay.
Yes, sir. Understood.
Now then, issuers who believe that their credit worthiness will decline frequently choose to use callable debt. No. Why so? Reason being, when will you issue callable debt? See, imagine you are issuing callable debt and then the credit worthiness is declining. Then what will happen to the IY of that company?
Interest rate.
Hmm. So
They'll pay
imagine
less, right?
what will happen to the IY of this company if it is frequently declining. If the credit worthiness is frequently declining, what will happen to the IY of the company?
It should go like will investors will expect a higher return, right? For
So it
taking
will
more
go
risk.
up. It will go up. Then why will they call
Yeah.
back? Callable is exercised when the interest rate is going down in the market. For them, it is going high. So why will they call back? So this feature has no connection. If you expect that creditworthiness will decline frequently, you are not going to add callable feature. Is it okay?
Yes, sir.
What is the next one?
The third one, sir.
This one, third one. Assuming
Yeah.
today T is equal to 0, the current US 5-year treasury note trades at a price equal to the bond's face value. That means par. USD 50 million. The security buyer takes delivery of the US treasury note today and pays the security seller uh, okay, USD 50 million. Assume a repo term of 45 days and a repo rate of 0.35. The buyers agree to return. The seller reprice. Okay, this is a proper calculations we have to do. Okay. One minute. The security buyer takes delivery of the US treasury note today and pays the security seller 50 million. Assume so it is a 5-year bond. Assume a repo term of 45 days and 360 days in a year and a repo rate of 0.375%. If the buyer agrees to return the 5-year treasury note 45 days from today, assume your repo. Assume that today T is equal to 0. The current US 5-year treasury note trades at a price equal to the bond's face value. So this is 50 million. The security buyer takes delivery of the US treasury note today and pays the security seller 50 million. Assume a repo term 45 days and 360 days in a year, and a repo rate of 0.375 percentage. If the buyer agrees to return the 5-year treasury note 45 days from today to the seller, the repurchase price is closest to the repurchase price. Assume the buyer agrees to return the 5-year treasury note 45 days from today to the seller, the repurchase. If the buyer agrees to return the 5-year treasury note 45 days from today, if the buyer agrees, if the buyer agrees to return, assume a repo means where is this repo coming in between? So this is US treasury note. Now assume a repo of 45 days and a repo rate, okay. If the buyer, so that means this is a second product 45 days, so this is 360 days, okay. This is okay 45 days. Assume a repo term of 45 days and a repo rate of 0.375 percentage. Repo term of 45 days, okay, and rate of 0.375 percentage. If the buyer agrees to return the 5-year treasury note 45 days from today to the seller, but who is the buyer now? If the buyer agrees to return the 5-year treasury note, okay, now there is mix. I'm just confused. Where is repo coming? Suddenly repo is coming. There is suddenly now treasury note is coming. 45 days from today to the seller, the repurchase price. I'm not able to understand only like who now repurchase is coming. So when did he sell? If the buyer agrees to return, assume a repo 45 days and a repo rate. If the buyer agrees to return the 5-year treasury note of 45 days from today to the seller, who is the buyer and who is the seller now here? The repurchase price is closest to 50 million, 50 million, 50 million. Not clear with the question only. This is one part. Suddenly they are speaking about repo, then suddenly they are mixing up with treasury note. Assume a repo of 45 days and a repo rate. Okay. If the buyer agrees to return the 5-year treasury note, so now coming back to 5 years treasury note, 45 days from today to the seller, the repurchase price. So basically this is the rate 0.375 percentage. You are selling and then you are repurchasing. Plus 0.375, okay, 0.375 percentage is for 360 days. How much will it be for 45 days? Just calculate this rate, cross multiply, find the value of x.
So it is 0.000
Hmm.
46875.
So that means 0.046875 percentage. Okay. Now better I see the answer only. This is question itself is not clear. So, okay. Question 3. Zero point 0.3. We didn't get this number in 45 days. Is this wrong then?
This one, the cross multiplication one.
Yeah. They have got some other answer. They have got 23. So it should be something like 0.02343 percentage, something like
So
that.
what
You
I did
should
was
get.
45 into 0.375 percentage divided by 360.
No, divided by 360, 45. This is what you did, right? 45 into 0.375.
Yeah, only the bracket thing. Yeah, the round brackets.
Okay. Forty-five by 360 into 0.375 percentage. 45 divided by 360 into 0.375 percentage. Forty-five divided by 360. Right, 45 divided by 360 into 0.0375.
It will be 0.00375.
0.375.
So yeah, that is we're getting the same 0.0004687.
0. One more zero will come. No, 0.375.
Yeah, like,
How are they getting this? This is incorrect.
this 50,000. They have multiplied it, right? Like with 50 million and 1 plus.
Oh, multiplied with 15 million. Okay, let me see. In effect, the security seller borrows 50 million on a short basis at a low cost with interest 23 paid at maturity because the loan is collateralized by the US Treasury. A is incorrect, C is incorrect. Is this matching? Shravani, are you doing this calculation?
Yes, sir.
Is it are you getting this number 50023?
No.
Achha, they said plus 1. So plus 1 equal to multiply by
Uh,
5 million, 50 million. Okay, it is coming to that answer only.
50 million 0 437.5, right?
Yeah. So that means if I continue what I did, uh, 45 divided by 360 into 0.00375, correct? Is equal to this much 0.00046875. Zero point triple zero 46875. Okay. So how did I get this? I got this by calculating 45 divided by 360, 0.375 percentage. Okay. So this one into 100. This is the rate. Uh, so this percentage into 15 million. Yeah, 23. Okay. Okay. So this is all correct only what we did, because I thought because this number is not matching anywhere here, so I thought it doesn't make sense. But if you multiply by 50 million, okay, it makes sense here. This number only you multiply by 50 million. See?
I got that number 50 million
Yeah,
and
23,438
23,438.
plus
But what did
50
we
million.
do here? Like that is the interest we are paying, or like,
That language only they have complicated highly. This
okay,
calculation is all fine only. That language, who is connecting with whom, what they are selling, buying,
yeah,
that calculation is the
it's weird.
understanding is the complications here.
So just we'll just have to get the repayment amount, right?
Huh. See here, I'm still not very clear with this language. Just that somehow, but just understood that okay, calculation perspective, this way it will be. So let me try again. But at least calculation is
So
coming
is it
correctly.
like we are calculating this percent? So here we are calculating the percentage for 45 days, right?
Yeah.
Like the borrowing
Yeah.
was for 45 days.
Yeah. Now there is 50 million. Now this guy has borrowed, right? So the security buyer takes delivery of the security and pays security seller. Okay. Assume your repo. Now this is in between another repo term 45 days and a repo rate of 0.35%. If the buyer agrees to return the 5-year collateral note 45 days from today to the seller. If he is agreeing to return the treasury note 45 days from today to the seller, that means he bought this and why is he agreeing to is buyer agrees to return, but he is returning treasury note 45 days from today to the seller. So there is treasury note of no treasury note is here only. If the buyer agrees to return 5-year treasury note 45 days from today, so he already bought. Now he says he will return after 45 days, and to the seller the repurchase price is closest to. He is buying, he is selling. So seller's point of view, seller has sold for 50 million and he will buy it. Oops. See, now you have to think from seller's perspective. The seller who sold, it is like this. The seller has sold it for 50 million. Now the seller has agreed to repurchase. So he is selling and then he will repurchase it for this amount, 50023,438.
The
He will
seller
buy
is
it and
making a
sell.
loss here. Right?
Yeah. Seller has to make a loss only because seller needs money. First of all, 50 million. He is the borrower. Basically, he has given his collateral. Okay. So when you say the buyer is buying, these are all the complications that they are deliberately making. The simple story is like this, that this seller, that means he is the borrower. What he did was, there was a borrower who said, please take my treasury note and give 50 million. And in return, he said, that means he is selling. Okay. And then again, he said, this borrower said, now you give back my treasury note and I will pay you 50 and then 023438. This is only the transactions. This only they have complicated language and they have made it from the angle of the buyer so that we get confused. The story is like this. So he is the seller, he sold, then he is repurchasing, and that's why the word is coming as repurchase price. So because we are thinking from buyer's perspective, the words are confusing us. Why is he selling and all that thing? Is it okay now?
Yes, sir.
Yes, sir.
Okay, so we'll stop now here. Okay, it's already 10:45. Okay, we'll stop here.